The one thing I hope people will take away from this interview is this idea. Peter, when you look at the CAPE ratio, so you take 10-year average of all the corporate earnings, you adjust it for inflation, and then you measure where all the stock prices are. And that ratio historically has bounced around between around 10 and around 20. Under 10, stocks are super cheap, like they were in the early 1980s. Over 20, stocks get expensive. And typically, this CAPE ratio peaks at around 30. So if it goes over 30, you're going to have a crash. That's what happened in 1929. In 2000, the CAPE ratio got all the way over 40. And of course, we had a very bad following decade for stocks. Stocks basically fell from 2000 all the way to the end of 2008. Well, we're back there. The CAPE ratio is now 37, Peter. And whether anybody wants to admit it or not, this means we are going to have a very poor period, multiple years, maybe a decade, maybe more of poor equity performance because stocks have already priced in all of the possible good news of this election. And now we've got interest rates marching higher. And I don't know if you'll agree with me about this, but that is a recipe for a big collapse in stock prices. What do you think?
I think there's a very big risk of that. As you say, the market's currently a sort of priced for perfection. There's a lot of optimism after the election because people saw what happened in Trump 1.0, right? Which is that he put in this pro-growth agenda, tax cuts, regulatory cuts, just taking the sort of monkey off the back of corporate America, the regulatory agencies, the EPA, OSHA, SEC, all the rest of it. Just getting rid of that threat grew the economy just amazingly back in 2017. But the question is, are we anywhere close to that right now?
This whole scenario reminds me very much of 1972. And in 1972, to win re-election, which he won in an overwhelming landslide, but Nixon was paranoid. So he was pulling all the same levers that Biden was pulling to try to win re-election. And Nixon grew the government enormously in 72, had a huge blowout deficit, and he set the stage for a big increase to inflation. You had the stock market fall by 50%, and you didn't necessarily have a typical recession, but you had this emergence of stagflation, where you had a very weak private sector economy, and you had a huge decline in the dollar. And right now, we're in the opposite of that. We're in this volcanic eruption of the entire currency world running into the dollar right now. And Buffett said, pretend you're going to be stuck on a desert island for the next decade. Tell me one stock you'd be willing to have all of your money in. And you wouldn't be surprised to know the names: Polaroid, IBM, GM, GE. Well, if you look at all of those stocks, the annualized returns over the next 10 years for all of those stocks was negative. And by 1982, the CAPE ratio on the S&P 500 was 7, which is the 100-year low. So people went from being more bullish and more greedy than they had ever been. 1972 was the Dow high. You had a CAPE ratio of around 25. That was an extremely bullish environment, and yet they were sleepwalking into the worst decade for U.S. stocks ever. People are so bullish right now on NVIDIA and on Tesla and on Apple. It is inconceivable to them that there could be a period of declining stock prices that is meaningful and that has a long duration. And yet we know from history, we know that that's what has to happen when stocks are this expensive.
There's a reason why the world's best informed investors read my daily journal. Subscribe for free at portersjournal.com.